Very good afternoon, dear learners. Today we are here to discuss a very relevant topic, that is international markets, instruments and institutions. This is basically part of the course International Banking Management. The course code is MMPB 002. So, in this particular session, we will basically discuss about the international financial system, which basically facilitates cross-border capital flows, number one. Number two, it integrates financial markets, institutions and instruments. It also enhances investment and trade efficiency, and it involves the regulatory, economic and political dimensions. And international financial system is also foundation for globalization and economic interdependence. What are the objectives of this presentation today? That is, we will try to understand the international financial markets. We will also try to identify the major financial instruments. We will also explore international financial institutions, analyze market linkages and roles, and also discusses what are the current global trends which are going on. This is basically, in this slide, we will discuss about the overview of international financial markets. Basically, international financial markets helps in facilitating global investment and financing. It includes capital markets, money markets, derivatives and foreign exchange markets. These international financial markets are basically interconnected through technology and regulations. The participants are governments, corporations and investors, and it is driven by interest rate, inflation and geopolitics basically. So the foreign exchange market is the largest and the most liquid global market, which enables currency conversion for trade and investment. The participants includes banks, multinational corporations and central banks. Like in the case of India, the central bank will be Reserve Bank of India. There are various spot, forward and swap transactions which occurs in the foreign exchange market, and the examples are, for example, the exchange of US dollar in euro and the US dollar in Japanese yen. Friends, the international capital markets basically provide long-term financing to the in the international trade in the form of debt and equity. The various instruments are euro bonds and foreign bond markets. There are cross-border IPOs and equity listings. It helps in, basically, international capital market helps in global investment diversification, and it also helps in assessing broader investor base. Now coming to the international money market, it is basically a short-term funding for global institutions. These are the instruments like commercial papers, certificate of deposits and treasury bills, which are basically traded in the international money market. It is basically used for the liquidity management purpose, and the active players in the international money markets are basically banks and financial institutions. There is very low risk and high liquidity assets in the international money market. Another market which basically operates at the international level is derivatives market. Friends, we know that derivatives means an instrument which basically derives its value from the underlying asset, which may be any gold and silver commodity like this, or it may be stock or anything from which the value can be derived. These instruments, derivative instruments, basically are used for the hedging purpose, and Sometimes it is also used by the speculators for on price movements. So what are the various derivative instruments? The instruments are swaps, forwards, futures and options. Basically, this derivatives market helps in reducing foreign exchange and interest rate risk. These derivatives are traded on exchanges, as well as these are also available over the counter. Widely, derivative instruments are used by the multinational corporations and hedge funds, because derivatives are basically used for the hedging purpose in order to cover the various kinds of risk. Basically, in the international financial markets, it is used for hedging the currency risk or market risk also. Now, the international money market we have already we have key international financial instruments are, friend, these are the key international financial instruments. Number one is currency forwards and futures, interest rate swaps, sovereign and corporate bonds, global depository receipts, which in short is known as GDRs, and ADRs also. These are all American depository receipts. The full form is of ADR is American depository receipts. Euro bonds and foreign bonds are also available in the international financial markets. Friends, these international financial markets instruments and institutions, they basically are integrated. Like the international financial instruments are available in the international financial markets, and international financial markets are basically part of the international financial system. So instruments, institutions and markets, they are basically should be taken should be taken into the comprehensive way. Now let us see what is Eurobond market. The Eurobond are issued in a currency outside the issuer's country. It is issued in bearer's form. Interest rate is usually annual in nature. The interest rate is paid per annum. It is not subject to heavy regulations. So Euro bonds are not subject to the heavy market regulations, and basically the global investors are more attracted towards the Eurobond market. For example, a Japanese firm issuing US dollar Euro bonds in London. Now coming to the foreign bonds. What are the foreign bonds? Basically, these are issued in domestic market by the foreign borrowers. These are regulated by the host country laws. Like some of the names I would like to share here is Yankee, Samurai and Bulldog bonds, which are available as foreign bonds in the international financial markets. These are basically denominated in the local currency. For example, Toyota issuing Yankee bonds in the US markets. So Yankee bonds are the bonds which are issued by the Japanese companies in the dollar form in US markets. So these are all Yankee bonds. So whenever Yankee name comes, it means it is a bond, foreign bond issued by the Japanese companies in the US markets. Friends, another instruments which is very popular in the international financial markets are global depository receipts. It is one of the most important instrument. These, what global depository receipts are, it basically allows foreign firms to raise equity in the international markets. These are traded like shares on European exchanges, and it represents shares held by depositories, and it increases investor reach and liquidity. For example, in very simple terms, if the Infosys has already issued GDRs which are traded on the London Stock Exchange, which is known as LSE in very short. So the Infosys has already issued the GDRs on the London Stock Exchange. So now coming to there is another instrument which is very popular among the players in the international financial markets is the American depository receipts. So American depository receipts are similar to the GDRs but traded in the US markets. These are all denominated in the US dollars, and issued by the US banks representing foreign stock, and these are listed on the New York Stock Exchange, or there is also another stock exchange which is known as NASDAQ. The Tata Motors, one of the you can say company of Tata Group, has already issued ADR which was listed on the New York Stock Exchange. So Tata has already issued the American Depository Receipt. Now coming to what is the role of international financial institution. The role of the international financial institution is it facilitates in trade and investment, promotes financial stability. Because why it promotes the financial stability? Because it facilitates trade and investment by offering different types of instruments in the market. It provides loans and technical assistance. Also, in the international financial institutions tries to monitor economic trends and support crisis and management as well as reforms. Friends, I would like to discuss one of the most prominent and popular financial institution. You might have heard the name of this, that is International Monetary Fund, which was the byproduct of the Bretton Woods Conference, which was held after the World War II. Okay, so this is the byproduct of the Bretton Woods Conference, International Monetary Fund, which basically ensures the global monetary cooperation. It offers financial support and policy advice to the member countries. IMF also tries to maintain the exchange rate stability in the member countries. It provides surveillance of the economies. Example, recently we have seen there was lot of crisis in the Sri Lanka. You might have seen this Sri Lankan crisis in 2013. So International Monetary Fund has offered a bailout plan for the Sri Lanka in that case, because Sri Lanka was the member of the International Monetary Fund. It basically works with the government in maintaining the balances in the balance of trade, as well as it also tries to ensure the exchange rate stability. Now coming to next very prominent institution, that is World Bank. World Bank is also byproduct of the Bretton Woods Conference, which was basically held after the World War II. This World Bank basically focuses on long-term economic development of the member countries. Number one, it provides loans, grants and expertise to the member countries. It supports infrastructure and poverty reduction. One of the example of World Bank as far as the India is concerned is Sarv Shiksha Abhiyan. The Sarv Shiksha Abhiyan is basically sponsored by the World Bank. World Bank came into existence in 1945. The headquarters of the World Bank is situated in the Washington DC, USA, and it works basically. There is a difference between International Monetary Fund and World Bank. International Monetary Fund basically provides fund only to the government or government institutions, whereas in the case of World Bank, it provides loans not only to the public sector, it also provides loan to the private sector also. Like if any company, big company in India wants loan from the World Bank for a bigger project financing, it can approach the World Bank. But the private sector cannot approach the International Monetary Fund for the funding purpose. Example is like in the sub-Saharan area of sub-Saharan Africa, World Bank has supported many rural development programs. So friends, we have already discussed about the World Bank. Now coming to the Bank of International Settlement. It is also known as Central Bank for central banks. It is the central bank for central banks. Friends, I am not talking about the Central Bank of India. I am talking about Reserve Bank of India, which is the Central Bank of India. So BIS is the central bank for all the central banks of the member countries. It facilitates monetary and financial cooperation. It hosts, you might be knowing about the Basel Committee. There are various Basel norms also which are applicable to the commercial banks. So it basically hosts the Basel Committee for banking standards. it promotes global financial stability, and you might be knowing about the capital adequacy norms. Right now, Basel III is applicable in the Indian commercial banking sector. So, the BIS, the Bank for International Settlement, basically decides how much, what will be the capital adequacy ratio which has to be maintained by the member countries central banks. Okay, so see, these Basel norms are applicable right now to all the banks which are operating in India. Coming next, there are other major financial institutions, friends. The most prominent one is European Central Bank, which is also known as ECB. So ECB basically manages Eurozone monetary policy. You might be knowing, friends, there are two types of policies. One is fiscal policy, another one is monetary policy. The monetary policy instruments are CRR, repo rate, reverse repo rate. So these are the few monetary policy instruments. So for the Eurozone area, there is European Central Bank, which basically tries to ensure the financial stability in Eurozone. So basically the European countries are part of the European Central Bank. The second prominent bank at the international level is Asian Development Bank. The headquarters of the Asian Development Bank is located in Manila, which ensures the balanced regional development. Basically, the preference of the Asian Development Bank is the balanced growth in the Asian countries. Next institution, which is also, you can say, the institution at the international level, is International Financial Corporation. Like IMF supports the government projects. It ensures the balance of payment stability. World Bank ensures the funds the public as well as private sector. In the same way, there is an exclusive institution which is known as International Financial Corporation, which basically provides funding to the private sector. Like, if any private sector company from India wants to expand or diversify its business, it can approach International Financial Corporation for a bigger amount. It can have loan from there. There is also a very, you can say, most of the Indian big projects are financed through IDA, International Development Agency, which is also a sister concern of the World Bank. International Development Agency, in short, which is known as IDA, it basically provides soft loans to the member countries. Most of the Indian infrastructure projects are funded through IDA. It is known as the soft loan window of the World Bank. So International Development Agency has funded a lot of projects in India also. There is another institution which is known as OECD, Organization for Economic Cooperation and Development. The full form is Organization for Economic Cooperation and Development, which provides policy guidelines and data sharing among the member countries. There is SWIFT, you might be knowing. SWIFT is a platform which helps in global payment messaging system. But there are various challenges in international finance which must be discussed, because the international financial markets institutions are not, you can say, they don't work in vacuum. They are subject to various kind of turbulence or risk. So the international financial area, somebody who is operating in the international financial area has to face various kinds of challenges. And first challenge is exchange rate stability. Exchange rate, as we have already discussed in the yesterday, that exchange rate is the price of one currency in the terms of another. The exchange rate fluctuation occurs due to the change in the interest rate, inflation rate, or if there is any disbalances in the balance of payment. There may be certain geopolitical reasons. There may be some other reasons for exchange rate fluctuations. So whenever a manager is operating in the international finance area, he has to basically sense the exchange rate, which is exchange rate risk. Number two is there are various kind of political and regulatory risk, because every country has its own law, every country has its own law, its own regulation. So when you are when as a company you want to raise fund from the US market, suppose, you have to abide with the laws which are there in the USA. So there are various political risk also, because we know that political risk has to be considered while funding the international projects. Third one is global liquidity crunches. Friends, it is not possible, because it is not the world economy is an integrated economy. For example, Indian financial markets have coupled with the international financial markets. Now, if anything happens worldwide, it affects the Indian financial markets also. So, if there is any global liquidity issues, if there are various global liquidity crunches, it also affects the various countries. Now, if you operate in the international finance area, you have to comply with multiple jurisdictions, because as we have already discussed that laws are different. So there is risk of contagion during crisis. Why contagion during crisis? Because we know the international financial markets are subject to the dominoes effect. Dominoes effect means if some things happen in a country which is in Europe, if our country has an economic relationship with them, we have to also face the consequences. So at the world level, because all the economies are integrated, so if something happens in one country, will definitely affect the another country also. This is known as contagion crisis. Now this is the summary. That is, we have already discussed about the international financial markets, instruments and institutions. We have also seen that how this risk which operates in the international financial area can be managed. We have also discussed that these are the swaps, forwards, future and options, which are also known as derivatives, which are available to manage the risk. These are in order to mitigate the risk also. So international financial institutions basically helps and supports stability and growth. And we must be, as a student of MBA program, we must be informed on global financial developments. As a student, you all should go through the various newspapers, newspapers like the Economic Times, Times of India, or there are various websites available, because you in order to take informed decisions, you must go through the papers, newspapers, magazines, websites, so that you can know what is going on at the international level, because the international political, social or economic events also affects the international financial system. So international financial system is very important as far as the international trade and the development of the global economies is concerned. So this is all from my side, friends. Thank you to all of you.